All right, so let's get back to this guy. MassMutual and Guardian. Key features, performance, specifically historical performance here, not projections, not illustrations. I'm so big on that because in the life insurance industry, we always see people selling off of the illustration. These show the best values. This is the company to go with. And guess what? The big guys do it too. The reality of things is when you look at policies that have lived the test of time, I do not want to buy a policy that looks the best, but then under-delivers, because what does that cause? Buyer's remorse. I thought I was going to have all this money, but you, Steve, you told me, and look what it's doing. No, you've got to be upfront about this stuff. From a historical, actual performance standpoint, going back to those 4 major mutual companies, the big 4 I talk about all the time, they disclose it. So both of these carriers, MassMutual and Guardian here, let's do this. We have seen them both consistently deliver. So let's give them each a gold star. Premium and PUA limits, to be specific here. Let's put this in red. MassMutual will allow us to go as aggressive as 1090, meaning wherever I set my base premium, they will not allow one to pay more than 10x that base premium as far as a total payment per year. So going back to that example, if we have a $10,000 base premium, my total payment can be $100,000 per year. Guardian, a little bit different. To be specific, 9.1 to 90.9%. I should just round it and say 991. Here's the thing. Wherever I set my premium, they will allow me to pay another 10x into PUAs per year for a total of 11x my base premium. Not really a huge difference when you look at the numbers, but that's technically the maximum you can go with them and illustrate with them. Flexibility. So both carriers are flexible. Here's the advantages here, or the differences, I should say. Let's do this. There we go. MassMutual. If the policy is constructed properly, we can easily make payment adjustments 1 time per year without medical underwriting. That's what I do not want to have to do again. Jump through a bunch of loopholes. 1 time per year on my anniversary date without underwriting. UW. If the policy is set up properly, I would refer to our All About MassMutual video where we go through really the flexibility features, different PUA riders, and a lot of detail there. Key features, flexibility with Guardian. They're pretty flexible when it comes to adding funds into PUAs. Anytime I just log on to my online portal, add funds, send a check, do it over the phone, wire it, whatever. They are definitely one of the most flexible carriers, and they've invested a ton into their technology. MassMutual is getting there. They've made a lot of improvements recently. I can see them there in the near future as far as adding PUAs on an unscheduled basis, truly at leisure. They've got their planned alert, which is, This guy, recognition. So MassMutual, primarily a non-direct recognition company if you select their variable loan rate, but they are also, or they allow the direct recognition contract to exist as well. Now, we don't usually recommend it because you've got to use different riders that strip the policy of that 1 time per year payment adjustment without flexibility, but they do offer technically non-direct and direct recognition. Transparency, right? We got to be transparent. Guardian is a direct recognition company. However, many people are not aware of this. At the 10th year, they offer non-direct recognition. We can switch our contract from direct to non-direct recognition. They're also a direct recognition company. Same thing applies to MassMutual's direct recognition contract, that when I say direct recognition, what typically pops in your mind? Something good or something bad? Usually it's negative, and we hear that the companies will not pay a dividend on borrowed funds. Furthest thing from the truth. With a direct recognition company, what that means, they will directly recognize the fact that we take out a policy loan and adjust the dividend on borrowed funds. Guardian, Mass Mutual, same thing with Northwestern Mutual, another one of the 4 major mutual companies, raise the dividend rate on borrowed funds. So they directly recognize the fact that we've taken out a loan and can raise or lower that dividend rate. Dividend rates. Mass Mutual, 2021, 6%. Guardian, 5.65%. Both have a guaranteed rate of 4%. Dividend rates with all life insurance carriers are gross rates. That is never what I'm actually earning on my policy. If we've ever heard that, right, it's not. So anytime we see the guaranteed rate or a dividend rate, that is the gross rate a company credits after the insurance expenses and mortality charges on a life insurance policy. Very good to be aware of that. What I like to look at personally is the net IRR, which simply tracks the actual growth over time. And then loan rate, Mass Mutual has a variable loan rate, presently with a floor of 5%. And then if I go with the fixed loan rate, this is what makes my contract direct recognition. That's at 6%. Whereas Guardian, they have a fixed rate at 6%. However, at that 10th year, when I have the option to flip it over to non-direct recognition, 4.5%. One last side note, because I think this is kind of neat. If I elect not to go non-direct recognition, keep it at the fixed, at either year 20 or age 65, whichever comes last, they drop that fixed rate to 4%. Okay, so a lot of information we're giving him, right, in this case study as far as the different carriers. Now, in the actual process, right, if you've worked with us, you know this. If you'd like to, you'll experience this, is we want to provide all the information. This provides 80% of it. But as far as specific questions in your scenario, hey, well, that's great, but what does it actually look like if I take loans out during the first 10 years, but then I flip it to non-direct recognition, then what would those loans look like over time? Is the loan balance, is the loan rate and non-direct recognition applied to everything now, or the first 10 years is still direct? It's flipped over to everything, my entire loan balance, but this is good stuff to be aware of. Questions that come up, we want to educate people on it. So, a lot of information here. Let's have some fun and look at the numbers. So, options. What options did he want to see? $100,000, the ability to go up to $100,000 per year. Doesn't want to get a bill for it. 5, 15 years, options, different companies, show me the different rates, the net growth, and then loan scenarios. Let's take a look. So, what we've got here, 2 companies. Company A, it's Mass. Company B is Guardian. As far as the product selection and the actual design, we've got more information in that on our membership program or in our Agent Academy. We show you how to build these products if you're in the industry. Here's what I want to look at. So, Mass Mutual, their product is really geared for an individual, in my opinion, who is comfortable with a one-time per year payment adjustment and may want to fund for a long period of time. Don't have to worry about a MEC or anything like that, as long as you don't drop a term rider or use the improper type of term rider right off the bat. So 5-year funding, $100,000 per year. Break-even point, year 5. This is a traditional long-term policy geared for long-term performance and the ability to keep on paying into it. Then we see the exact same product here. Year 5, cash value and death benefits are identical. From this point forward, I keep on paying in $100,000. Obviously, I have significantly more money because I've pumped more money into cash value. So, MassMutual here, the ability for the individual to keep paying funds into the product, one time per year payment adjustment though, with the setup here. Meaning year one, let's say he pays $100,000. If year two comes and he says, hey, I can't make the full $100,000 payment. His base premium is still $10K. He can reduce his payment, let's say to $30K, things slow down. And then the next year, year three, if he wants to increase it, he can bounce it back up. The thing is, to avoid any type of loopholes or medical underwriting, the anniversary date is when he can make that payment adjustment. He can actually pay in a total of $170 if he wanted to make up for the lost time, the unused mech space. And you can do that every year. Again, you've got to set the policy up properly, but it is possible. So, Company A, 5 years and 15 years worth of funding. Company B, here we go. 5-year fund, 15-year fund. Difference here you see. The 5-year, that looks sweet. About 90% right off the bat. Traditional whole life insurance product, that is juicing it for cash value. We minimized everything we could here. Death benefits, you'll notice, are very, very consistent with both companies initially. 45-year-old male, that 2.35 figure, 2.35 million. MEC limit, almost a clean $100,000. Breaking even almost year three, between years 3 and 4. That is strong for a whole life policy, one geared for strong long-term performance. Now, when we look at the 15-year fund, this is the same product, but what do you notice different here? 82.5% right off the bat, much higher death benefit. So, in my opinion, when we are designing policies for maximum cash value, Guardian's sweet spot is funding something, a max fund for 5, 10 years or less. You can do a lot of damage with their product. You can make this 15-year look a bit better actually using different products, but I want to keep it apples to apples. But 5 years, 10 years or less at the max fund amount, and continue to fund after that if we want to, just not at the same level, that's where you can do a ton of damage. And specifically why, you'll notice this death benefit is much higher. Had to add a larger term rider to prevent the MEC from occurring. They've got one PUA rider, not multiple PUA riders like MassMutual. I don't want to get too technical here, but point being is we wanted to make sure we prevented a MEC in all circumstances. And as a result, by raising the expenses, had to raise the base premium a little bit due to the policy limitations. We ended up lagging a little bit on cash value. And this is the non-guaranteed. We ran a guaranteed report as well. But again, it's an option to see. Like, this is the kind of stuff we want to go through initially when we're working with someone, or build awareness through video content. That way we know it and don't find out after the fact. That's not fun with anything aside from just life insurance. Oh, I'm having too much fun here. So let's continue on. Options. So we looked at 2 companies, 2 products there, different funding periods. Typically, if we're working with someone live, we will show more than that initially. Start broad and then start to narrow things down so we can get all the information. Different assumptions. What does it look like in a worst case scenario? So we can do this for all of them. I'm just going to do one in this example. This is company B, which are these guys, okay? Guaranteed rate. Present dividend rate, and also their indexed feature. All the same product. That indexed feature is something we can switch back and forth between that and the dividend over time. You can break it up 50-50%. However you want to redirect that allocation. We do have additional content on that as well under indexed whole life if you'd like to understand that further. But seeing the actual growth over time. So this is really where I enjoy shedding light or providing clarity on cash value life insurance and the growth over time. Specifically, guaranteed rate of 4%. Sounds great. Am I actually earning 4%? Dividend rate of 5.65%. Am I actually earning 5.65%? Indexed feature. Like, is that what I'm earning? Do I got to crunch it with a calculator? We'll do it for you right now. So here's what I like to look at. Internal rate of return. Now this just displays the annual because we've got our own formula, so I can do it quick. It is good to look at the average as well, factoring in all years. But this serves as a great starting point. Here we go. So we want the information here. Good. This is with Guardian. So the base premium is about $9,100. So if you're a client or a policyholder, do you need to know every detail I'm going through here? Probably not. But if you want to know, we'll be sure to tell you. If you don't want to know, but just want the maximum cash values, we'll be sure to do that as well. I mean, that's our process. Make it convenient as possible for the consumer while maintaining absolute transparency. So what is highlighted in yellow represents the break-even point. These are guaranteed values, by the way, which we pull directly from the software from all insurance carriers. Just about breaking even year 5. I've paid in $500. I've got $498. That is strong, solid. Annual IRR, first year, a little over -10%. What does not show up in cash value in the first year? With this option, the base premium, going back to the policy design, premium, PUA, premium, PUA, overcharge in the first year, sometimes first and second. With Mass Mutual, that was the case. But year 1, they overcharged for that. As time passes, gets better and better. Tops out. This is tax-free if I do everything right. Don't mech it out or anything like that. 3.3% for a safe, liquid area to position money. Many view these products as a fixed asset, just an alternative. We have access to it as well, but if I've got a bunch of cash just sitting there or money in another fixed asset, a great area to consider shifting funds over. Oh, and look at the death benefit. I leave income tax-free as well. A lot of benefits when utilized and leveraged properly. There's the guarantees. Here's my gross dividend rate, 5.65%, tops out a little over 4%. Same thing with the indexed feature, a little over 6%, tops out just over 5% annual. So this is what I'm earning year over year. Annual internal rate of return, then we have the average internal rate of return. We don't have the average up here. The average would factor in over 20 years, the negative years as well, up front, and when it took some time to get going, I might see an average of a little over 4% in this example, maybe 4.25. Point being, the average factors in all years, whatever study period I'm looking at, where the annual isolates each specific year. Last example, in-depth case study, but we're trying to cover all of the main points that we'd cover with you if you are looking to work with us, or you can go over with an agent you're working with, or we've already covered with you in one way or another if you've worked with us. So, on the left, 5-year fund. This is now going back to Mass Mutual, overcharging in the first and second year. Breaking even, year 5. Included the dividend column here. What I want to touch on, Mass has a 2021 dividend rate of 6%. If you take this figure with a calculator and say, okay, here's my cash value growth year over year, this is not 6% on this dividend column. It's not even close. The reason why is that anytime we take an actual life insurance illustration and you see that annual dividend column, that reflects the company's surplus only. So if you take an illustration with Mass Mutual, they've got a guaranteed rate of 4%. They declared a surplus of 2%. The two together equals 6%. The purpose of going through that is the dividend column on a life insurance illustration only reflects the surplus, not the guarantee. The guarantee is reflected in the net cash value growth. So we have a growth example, let it sit and grow over time, excuse me, and then we have a loan example. Here we go. So what does it look like when I actually take money from my policy? So the first thing we look at here, his goal was using it for business. $150,000 loan in year 2. When I take that $150,000 out, the cash value is the gauge, call it the equity, that determines how much I can access from my policy. When I pull that out, look at my cash value. Remaining equity that I can borrow, $21,500. If I let it sit and grow, there's $179,000. Now, the company is going to continue to pay you the same dividend rate and the same guaranteed rate as if you never touched it in the first place. Why would an insurance company do this? If I'm you, if we flip positions, why on earth, let's say you're the insurance company, would you pay me a dividend when I pull money out? Like, you can't earn anything on it anymore. Well, if you're an insurance company, what is your first and foremost obligation? To pay out life insurance claims. Anytime I take a policy loan, my death benefit is collateralized dollar for dollar. Look at this. Example where I let it sit and grow, 2.655. Over here, 2.505. I pulled out 150, clean reduction by 150. Now, in this example, we do pay it back. So there is interest on the loan at 5% in this example. There's the loan interest. We pay it and pay the principal back at $30,000. That means years 3 through 5, when I'm paying it back, I'm paying the loan principal balance back, the loan interest, and the $100,000. Good to be aware of that. When it is repaid, or when it was outstanding, what do you notice about those dividend columns? Identical. How about when it's paid back? Everything is 100% restored to exactly what it would have been as if I never touched it in the first place. Constant compound, kept on accelerating and moving forward for me. And it's a whole life product, so it's safe, predictable. I know what I'm going to get. Don't have to worry about fluctuating insurance expenses, cap rates, nothing like that. So, fully restored. Same thing when we repeat the process, $500,000 loan. Reduction in death benefit, cash values equity. When we pay it back, look at your cash value in DB, fully restored to what it would have been as if I never touched it in the first place. A lot of information here. Also a lot of information we have not touched on. One supplementary piece of information on the loans and the loan interest is that 5%, many feel that it is high right now, because it is in the interest rate environment. A lot of banks, a lot of lenders are in the game, in the space of cash value collateral loans, where we can assign a portion of our cash value to a lender and receive a loan, a line of credit from them, very similar to borrowing directly from the policy at a more favorable rate. And if it's a business loan, that could be a potential tax deduction. Always check with your CPA or tax attorney. So again, know this was a lot of information. If you have questions, would like more information, or would like to see custom samples, reach out anytime. As always, I do hope that this helps, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.